Why is Fubo TV stock crashing? It's down a whopping 94% off its highs that it reached in late 2020. I'm going to answer that question and more upcoming in this video. Hi everyone, my name is Parkev and I post videos daily on stocks, the stock market, and investing. If this sounds like something you want to get more of, please subscribe. So let's get right into why Fubo TV stock is absolutely crashing, and it starts with its unit economics, the business model, what it does, the core business. And so if you're not aware of what Fubo TV does, they are a sports centric streaming alternative to cable TV. So just like a traditional cable TV bundle, you get a bundle of TV channels with Fubo TV, and you pay a monthly price, whether it be $64.99 or $74.99 or $84.99, depending on some of the features you might add or not add. And that's the similar to what the price you would pay. It's less expensive than a traditional cable TV connection. Plus, you don't have to get a professional installer come to your house to install everything. And then you can also take it with you anywhere you go, so it's a lot more convenient. You can take your subscription anywhere you could get an internet connection with your phone. And so it's a lot more convenient. So it has that tailwind at its back, driving customer growth and expansion. But why is it why is the stock crashing so much? And it has to do with the fact that it's generating massive losses on the bottom line. The company in its most recent quarter generated an operating loss of 112 million, up from an operating loss of 81 million in the same quarter the year before. And this is in the quarter ending June 30th. But what's driving the bulk of the losses is coming from subscriber related expenses. You see here, that's their number one operating expense, 218.9 million, and subscription revenue was 199.9 million. So subscriber expenses are higher than subscription revenue. What that tells me is that Fubo TV is paying more for the rights to the content than it's charging subscribers. So it has a bunch of channels, let's say Disney, ESPN, I don't know all of the channels that it might have, A&E, ABC, and all of that. So it has to pay TV studios for the rights to air that content to its subscribers, but it's paying more than it's charging its customers. And so it's generating these losses on the bottom line. It's unsustainable, and investors can see that. They see that something drastic needs to change here in order for this business to become sustainable. And one of two things needs to happen. Either Fubo TV needs to get to a large enough scale to have enough subscribers to where they could go to the studios and have increased negotiating power and say, look, we have all of these subscribers, lower your per subscriber cost that you're charging us. Otherwise, we could threaten to remove you from the selection of channels that we offer our customers. And in that way, it would decrease the subscriber related expenses and create a gap between revenue and expenses and stop those losses on the bottom line. The other thing they can do, which is more realistic considering its relatively small scale compared to the studios, is to just raise prices. Just raise prices on your monthly subscription that you charge customers. Now, of course, that's going to come with the risk that if you raise prices, you're not going to get as many new subscribers, and at the same time, a lot of your existing subscribers might cancel your subscription, because that's what we do as customers. When prices go up, we buy less. But that's still, in my opinion, more favorable than having this business on an unsustainable footing where you're not charging customers enough to at least cover your expenses, to at least break even and stop all of these losses on the bottom line. And if we look up higher, this is their most recent shareholder letter, and if we look earlier, management said they see meaningful opportunities to continue reduce internal costs as well as to drive improvement on content related unit economics. So they acknowledge that they see this as a problem here. The unit economics here is just not matching. It's costing you more than what you're charging your customers, and so this you can't operate a business if you're selling the product consistently at a lower price than what you're getting charged for. It's just unsustainable. You're going to go out of business eventually. You're going to burn through your savings, and you can't borrow any more money to sustain it. So it's eventually it's going to end. But another thing they noted is that they are taking tactics or changing strategy designed to strengthen monetization, including increasing take rate of higher ARPU products. ARPU stands for average revenue per user among new subscribers, and the migration of lower ARPU subscribers to higher ARPU bundles. So a lot of jargon there, a lot of CEO and CFO jargon. And let me break that down for you. Let me kind of make it put it into words that everyday regular folk can understand here. And what they're saying here with increasing take rate of higher ARPU products is the add-on features, right? So you might, the base price of Fubo TV might be $64.99 per month, but they might charge you an extra $4.99 per month for an extra 5 gigabytes of storage space, for instance. So that's a high margin adding product, and so if they can entice more folks to add those kinds of features onto their bundles, that's going to expand revenue and keep costs low, and thereby reducing losses on the bottom line. The second thing they note here is the migration of lower ARPU subscribers to higher ARPU bundles. And what they mean here is that there are some customers on the lowest priced plan, and they're essentially raising prices and getting these customers to switch over to the higher price bundles. So instead of management, in my opinion, coming out and just saying that, hey, we're raising prices, because then investors are going to fear that they're going to lose customers if they raise prices, they say it in more elegant terms. They say they are migrating lower ARPU subscribers to higher ARPU bundles, right? We're not raising prices. We're migrating these folks. We're gently guiding them towards these higher ARPU bundles. We're not telling them, hey, you're going to have to pay a higher price. So just in very gentler, kindler terms, management is telling us that they are indeed raising prices. They're acknowledging that they see this issue, this unsustainable unit economics, and so they're addressing the issue. So that's, in my opinion, good news for investors. You're seeing management address an issue that is concerning, that has caused, arguably is the reason that the stock price is down close to 95%, and they're addressing it. So the next step as investors is to monitor this progress. So we're going to look at the next quarterly update, which I will have an update for you. So if you're subscribing to the channel, you'll see that update when their next earnings comes out. I'll monitor this progress. I'll take a look at how the business changed because of this increase in prices. How many customers canceled? How many new subscribers joined? What difference did it make in terms of revenue and expenses and losses on the bottom line? And I'm going to want to see this trend over the next 1 quarter, 2 quarter, 4 quarters, and 6 quarters, and see if the business can slowly put itself on more sounder footing going forward. Okay, so that's all I've got for this update on Fubo TV and why the stock is so unprofitable, why they're generating so much losses on the bottom line, and why the stock is down 95%. So stay tuned, subscribe so you can see the updates and see how this business evolves, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.